Most people think a bank account is a safe haven, but in 2026, it's actually a liability. The money you have sitting in a checking or savings account is not really yours, not in the way you think. The bank can freeze it, the government can devalue it, and under the bail-in frameworks, quietly adopted after 2008, the bank can even take a portion of it to save itself. That's not a conspiracy theory. That's the legal reality of how fractional reserve banking works. Meanwhile, the ultra-wealthy have been quietly moving their liquidity off the grid. They've created parallel financial environments where their capital is untraceable, accessible, and entirely under their command. They don't trust the system because they understand the system's limits. Today, I'm going to show you the 5 secret environments where the elite hide their capital. And by the end of this, you're going to have a very different view of what it means to be wealthy in 2026. Because the question isn't, how much money do you have? The question is, where do you keep it? Let me introduce you to something I call the glass bank versus the concrete vault. Most people store their wealth in a glass bank. Visible, vulnerable, fragile. The wealthy store theirs in a concrete vault. Hidden, impenetrable, solitary. Let me show you the difference. Here's what most people don't realize. The banks you trust with your life savings are operating on a fractional reserve system. That means for every dollar you deposit, they lend out roughly 9, while keeping only a fraction available for withdrawal. In the United States, the reserve requirement, the amount banks must physically hold against deposits, has historically been around 10%. That means if everyone decided to withdraw their money at once, 90% of it simply doesn't exist. It's been lent out, invested, traded. It's already gone. Now, most of the time this works, the system assumes not everyone will show up at the door at the same time. But in 2008, they did. In 2023, Silicon Valley Bank depositors showed up, and the bank collapsed in under 48 hours. Not because the bank made bad loans, but because depositors lost confidence. And when confidence goes, the money goes with it. Except it doesn't, because it's not there. This is where the term bail-in comes from. In a bailout, the government uses taxpayer money to save the bank. In a bail-in, the bank uses depositor money, your money, to save itself. The legal mechanisms exist, quietly, in jurisdictions all over the world. Cyprus did it in 2013. Greece did it. And in the US, the FDIC has made it clear that in a major crisis, insured deposits will be protected, but uninsured deposits, which are anything over $250,000, are on the table. Here's the number. In the US alone, there's roughly $17 trillion held in bank deposits. The FDIC Insurance Fund, it's about $128 billion. That covers less than 1% of what's on deposit. So when I say your bank account is a liability, I don't mean it will necessarily fail tomorrow. I mean that you have zero control over whether it's accessible, how much it's worth, or whether the bank can use it to fix its own problems. This is not a doomsday prediction. This is a simple recognition of the rules of the game. The wealthy have read the rule book. Have you? Let me tell you about someone I'll call James. James runs a family office in Switzerland. That's a private wealth management firm for ultra-high net worth families, people with assets over $100 million. When SVB collapsed in March 2023, James's phone didn't stop ringing for 72 hours. His clients weren't calling to ask if their money was safe. They were calling to ask one question: what's the fastest way to get it out? James told me something that stuck with me. He said, "My clients don't have bank accounts like you and me. They have bank relationships. And those relationships aren't built on trust. They're built on alternatives." What he meant was this: the wealthy don't park their money in a single bank and hope for the best. They structure their financial lives across multiple independent channels. Each channel serves a different purpose. One for daily liquidity, one for long-term storage, one for political risk, one for currency protection, and one for complete invisibility. The kind of capital that no one in the world knows exists, except the owner. In James's words, the average person uses a bank like a mattress. They put everything in one place and hope it doesn't burn. My clients treat their money like a military supply chain, diversified, redundant, off-grid. After SVB, James moved over $800 million out of traditional bank deposits and into what he called private liquidity environments. Not all at once, not all in the same place, but the trajectory is clear. The elite are migrating. He described the 5 primary channels they use, and that's exactly what we're going to walk through right now. Method 1. Physical tangible assets. Gold, silver, and beyond. The first and oldest method is physical, tangible assets. Gold, silver, platinum, and increasingly, art, vintage watches, rare collectibles. Now, when I say gold, I don't mean gold ETFs or paper gold certificates. I mean gold bars that you can hold in your hand. The wealthy don't buy gold to get rich. They buy gold to protect wealth. It's not an investment, it's insurance. The global gold market is approximately $13 trillion. Central banks have been buying gold at the fastest pace since 1967, over 1,000 tons in 2025 alone. The Chinese central bank added 150 tons. The Russian central bank added 100 tons. Why? Because gold has no counterparty risk. It doesn't depend on a government, a bank, or a digital ledger. It's value you can hold in your hand. But here's the twist. The wealthy don't store it at a bank. They store it in private vaults, in multiple jurisdictions, sometimes in countries that don't share banking data with their home country. Switzerland, Singapore, Dubai. The number. Physical gold has appreciated roughly 15% annually over the last 5 years, while inflation has eroded the purchasing power of the dollar by about 20% in the same period. That means if you held $1 million in dollars 5 years ago, it buys you about $800,000 worth of goods today. If you held $1 million in gold, it would now buy you over $2 million. This is why the wealthy allocate 5 to 15% of their net worth to physical, private, off-grid assets. It's not for returns, it's for survival. The second method is private lending and directly lending money to other individuals, businesses, or real estate projects, bypassing banks entirely. This is how the wealthy act like a bank without being one. They lend money at 8 to 12% interest, secured by collateral, real estate, business assets, inventory. If the borrower defaults, the lender takes the collateral. The key here is that private lending is completely off the grid. There's no central database, no credit report, no government oversight beyond basic tax compliance. It's a bilateral agreement between two parties. Imagine you have $500,000. You lend it to a developer building a condo project. They pay you 9% per year, about $45,000 annually. The loan is secured by the property. If they don't pay, you foreclose and own the condo. This is not available to the average person. It's relationship-based. It requires legal infrastructure. But more and more, platforms are emerging that democratize this. The wealthy have been doing it for centuries. It's called private credit, and it's now a $2 trillion global market. The third method is self-custody digital assets. Specifically, cryptocurrency held in cold storage, offline wallets that no exchange or government can touch. Now, I want to be clear. This isn't about buying Bitcoin on Robinhood or Coinbase. That's not self-custody. In those cases, the exchange holds the private keys. You own the asset in name only. It's still in a glass bank. Self-custody means you hold the private keys yourself. You are the only one who can move the money. No one can freeze it. No one can seize it. No one can see it unless you choose to reveal it. There are currently about $1.5 trillion in crypto assets globally. Of that, an estimated 25 to 30% is held in self-custody, wallet addresses not associated with any exchange. Here's the number. After the FTX collapse in 2022, self-custody Bitcoin addresses increased by 40% in just 6 months. The lesson was learned. If you don't hold your keys, you don't own your coins. The wealthy now store significant portions of their liquid wealth in cold storage. Multiple wallets, multiple jurisdictions. multiple keys distributed across trusted associates. The result? Instant, global, invisible liquidity, accessible from any internet connection. The fourth method is legal structures, private family trusts and foundations that hold assets outside the individual's personal name. This isn't tax evasion, it's legal asset protection. The wealthy place their wealth into a trust structure where they are the beneficiary, not the owner. If a lawsuit comes, the trust is protected. If a bank fails, the trust is protected. If a government imposes capital controls, the trust is protected. Trusts can hold bank accounts, real estate, gold, private equity, and cryptocurrencies. Because the trust is a separate legal entity, creditors cannot access it. Divorce courts cannot access it. In many jurisdictions, not even the government can access it without a court order that is almost impossible to obtain. The number, in the US alone, there's over $70 trillion held in trusts and estates. That's more than the entire GDP of the United States. The wealthy use trust structures to create what's called generational wealth, wealth that survives not just a bank collapse, but a family collapse, a lawsuit, a divorce, or even a government regime change. And here's the secret. The wealthy don't just have one trust. They have multiple, across jurisdictions. Liechtenstein, the Cook Islands, Nevada, South Dakota. Each has different legal protections. Each serves a different purpose. The fifth and final method is the family office itself, a private investment entity that manages the family's wealth across all asset classes. A family office is effectively a private hedge fund for one family. It employs analysts, accountants, legal counsel. It makes direct investments in private companies, real estate, venture capital, private credit, and increasingly, alternative assets like rare art, classic cars, and even collectible watches. The key here is that family offices don't report to anyone. They're not public. They don't file with the SEC in the same way mutual funds do. They have minimal disclosure requirements. Globally, there are over 10,000 family offices managing an estimated $10 trillion in assets. That's roughly the same size as the entire hedge fund industry, but completely invisible. The wealthy use these structures to hold their most private assets, the art that hangs in their private homes, the gold stored in private vaults, the direct investments in startups that will never appear on a public market. A family office is the concrete vault in its most sophisticated form. It's not just an asset holder, it's an operating system for private wealth, and most people don't even know they exist. Now, here's the part that no one talks about. I just gave you 5 secret environments where the ultra-wealthy store their liquidity, and right now, somewhere between 50 and 80% of you watching this will do absolutely nothing with this information. Not because it's complicated, not because you don't have enough money, but because of something called the status quo bias. Your brain is wired to stay in the current state. You've had a bank account your whole life. Your parents had one, your grandparents had one. The idea that it might be the wrong place to store your wealth is so unsettling that you'll simply choose not to believe it. The wealthy don't have this problem because they don't think like you. They think, what if the system doesn't work? And then they build an alternative. This is the difference between the wealthy and everyone else. Not the size of their bank account. It's the structure of their thinking. The wealthy ask, what if, and then prepare. The masses wait for the system to reassure them. The behavioral gap is real. Studies show that over 70% of people receiving information that challenges their financial assumptions will ignore it until it's too late. To be fair, not everyone needs to operate like the wealthy. Most people don't have $50 million to diversify across family offices and private vaults. And the average person doesn't need to hide their liquidity from institutional risk if they're living paycheck to paycheck. But that's not the point. The point is understanding the game. The wealthy are not playing the same game you are. They're playing a game where the rules are different, the tools are different, and the risks are different. And unless you understand that, you're playing a rigged game. You don't need a family office, you don't need a private vault in Dubai, but you do need to ask yourself, if the banking system faced a major disruption tomorrow, what would happen to my money? If you don't have an answer beyond, the FDIC will protect me, you need to think harder. So where do you start? Not with a vault in Switzerland, not with a trust in the Cook Islands, but with 3 simple steps. Step 1. Diversify your custody. Don't keep all your liquidity in one institution, one checking account, one brokerage, one app. If any one of them freezes, you're locked out. Open accounts at 2 or 3 different institutions, and make sure one of them is a credit union. They are differently regulated and historically more stable. Step 2. Convert a percentage to tangible assets. Gold, silver, even if it's just $5,000 worth. Physical metal that you hold, not a paper certificate. If the entire digital financial system went offline for 72 hours, physical gold still has value. You can hand it to someone and walk away. Step 3. Learn self-custody of digital assets. Take $100, buy some Bitcoin or Ethereum, and move it to a cold wallet, a hardware wallet like Ledger or Trezor. Learn the process. Not because you need to be a crypto trader, because you need to understand what it feels like to hold your own assets with no bank in between. Those 3 steps will shift your mindset. You'll stop thinking like a depositor and start thinking like someone who takes responsibility for their own wealth. Once you've stopped trusting banks, you start to see the world differently. The headlines about inflation aren't just numbers, they're attacks on your savings. The news about bank failures isn't just someone else's problem, it's a warning. The behavior of the ultra-wealthy isn't paranoia, it's preparation. This is the POV shift. You stop asking, is my bank safe? And start asking, where else can I hold my value? The wealthy have their private liquidity. They have their gold, their trusts, their self-custody digital assets, their family offices. They sleep at night not because they trust the system, but because they've built alternatives to it. Now it's your turn, not to become a billionaire, but to take one step toward a financial life that doesn't depend on the goodwill of the banking system. So here's my question for you. Which of the 5 methods surprised you most? Which one do you want to learn more about? Comment 1, 2, 3, 4, or 5 below so I know what to cover next. If you made it this far, you already care more about your financial future than most people. Hit subscribe, and I'll see you in the next one. Because the system isn't going to fix itself, but you can fix yourself, and that's what this channel is about. See you next time.